If you have company stock inside your 401k, there's a tax break most people never hear about. And the standard move everyone makes when they leave a job erases it permanently. Roll that 401k into your IRA before you've checked this, and on a $300,000 stock position, the cost to you and your family can run into tens of thousands of dollars, gone in one signature. We've spent decades watching people make that move without ever even knowing they had a choice.
Educational content only, not personalized investment advice. All investing involves risk. Consult a qualified advisor. Apella Wealth. Full disclosures below. It's called net unrealized appreciation, NUA for short. And the mechanism is simple. Instead of paying ordinary income tax on your company stock as it comes out of a retirement account, NUA lets you pay ordinary income tax only on what you originally paid for the stock, your cost basis. All the growth is taxed at long-term capital gains rates and only when you sell. Why does that matter? The top ordinary income rate today is 37%. The top long-term capital gains rate is 20%, just under 24% once you count the investment surtax. That gap is the entire opportunity.
Let's make it real. Say you've worked at the same company for 25 years, and along the way, $1,000 a year went into company stock inside your 401k. That's $25,000 in. That's what we call your cost basis. Now you're retiring. The stock is worth $300,000. The automatic path, everything just rolls into an IRA when you leave the company. Eventually, all $300,000 of that stock has to come out taxed as ordinary income. Under the NUA path, the company's stock moves out of the plan into a regular brokerage account. And immediately you pay ordinary income tax now, but only on your basis, only the $25,000 you put in. The other $275,000 isn't taxed until you sell. And when you do sell, it's taxed at those lower long-term capital gains rates on your schedule, not the IRS's. That's the difference between the two rates applied to $275,000 of growth. That's why we think this is worth 8 minutes of your attention.
So who actually has this sitting in their plan? Someone who's worked at the same employer for a long time, for example, whose 401k put contributions or matching contributions into company stock, and who's now retiring or changing jobs. We see it with corporate executives, engineers, utility employees, certainly the big tech firms, pharmaceutical companies, and a lot of the Fortune 500 payrolls. And if that stock sits in your spouse's 401k, put this on the radar for them too. The rollover decision usually happens fast, likely in the middle of a job change or a retirement send-off, exactly when no one's thinking about the tax code.
This channel shares the conversations that usually happen behind closed doors, not out in the open. If you'd rather hear about a move like this before the paperwork is signed rather than after, subscribe.
So NUA is only available if you meet the requirements, and they're strict. First, you need a qualifying triggering event. Retirement or separation from service are the common ones. Death and disability also qualify. Secondly, it has to be a lump sum distribution. Generally, the entire plan balance leaves the plan within the same tax year. This isn't a partial move. So if you had $1 million in the 401k and $300,000 of it was in company stock, the stock moves in kind into your brokerage account, meaning the actual shares transfer. Nothing gets sold. The other $700,000 rolls directly to your IRA. All of it, same year. Third, timing and age matter. If you're under 59 and a half and don't qualify for the age 55 separation rule, there can be a 10% penalty on the cost basis portion. One more reason to run the numbers before you act, not after.
Now, here's the one thing you can't afford to get wrong. If that company's stock gets rolled into an IRA, the NUA opportunity is lost, not reduced, lost and gone forever. This is one of those planning opportunities where you get one bite at the apple, and once it's done forever. Nobody sends you a warning letter first. The rollover form doesn't ask you, are you sure? So if your spouse or anyone you care about is holding company stock in a 401k, this video is a warning letter. Send it to them before the paperwork gets signed. This is so unusual. Why haven't you ever heard of it?
So honestly, there's very little education around it. It applies to a smaller slice of the population. Again, you need company stock in the plan. You need to have it grown substantially. so it never gets the attention it deserves. The people it applies to tend to find out one of two ways: from an advisor who brings it up before the rollover, or from a tax bill after.
Which is exactly why knowing it exists is the most important part of the battle. Now, we'll be straight with you because this one really isn't one for everyone, but where it works, it really works. And we find that probably less than half of the situations that even have company stock in their plan does it work for. But it's something that's good for you to know.
For NUA to make sense, the stock usually needs to have grown a lot, hundreds of percent, not just 20 or 30. You need the cash to pay the tax on the cost basis up front. And that can be real money. And the math depends on today's gap between ordinary income rates and capital gains rates. That could change overnight with Congress in either direction. There are also state income tax considerations and sometimes estate planning wrinkles. Your situation has to fit. Someone who's changed jobs 4 times may have only built company stock at one of them. One thing that isn't a requirement, though, holding the stock forever. You can actually sell it right away if that's the right call. The long-term capital gains treatment applies either way.
And there's one more thing that has nothing to do with taxes. You'd be holding a concentrated position in a single stock. Think about this. The S&P 500 could go up 10% in a year while your company stock goes down 10%. There are no guarantees. It's one stock with what we call company-specific risk, not a market of stocks or a basket of stocks. We see this with families all the time. So say Grandpa Willie worked at IBM for decades and he hands the stock down and nobody can get themselves to sell it because it's been so good to us. But if Grandpa Willie had worked for Kodak, that loyalty reads very differently. So the question is never just, does NUA save tax? It's, does holding the stock still fit your plan? Taxes are part of the decision, but they're not the whole decision. Don't let the tax tail wag the dog.
So here's what to actually do. If you're retiring or changing jobs and there's company stock in your 401k or your spouse's, don't sign anything. Ask 2 questions first. 1, what's the cost basis of the company stock in the plan? And 2, what do both paths look like with real numbers? NUA versus the rollover. Your advisor and your CPA should run that together on paper before a single share moves.
Because the biggest planning opportunities are usually the quiet ones. And this one only exists until the moment you roll it away. In our example, $300,000 of stock got the tax break, but $700,000 still rolled into an IRA. And here's what nobody tells you about that account. Part of that balance was never yours. Here's a video that shows how big the government's share of your IRA really is and what smart families do to shrink it before the IRS names its price. Watch it now, because investing is the easy part.